The year is 2025. The stock market seems strong, but something is off. The top 10 stocks in the S&P 500 now make up a huge 38% of the whole market. That's a lot of power in just a few companies. This level of market concentration is making experts nervous. It reminds them of other times when the market was overly reliant on just a few big players. Times like the Great Depression. This trend has everyone asking, is the US stock market overvalued? Are we headed for a fall? No one knows for sure, but smart investors are paying attention. They are looking for signs of trouble. They are preparing themselves. This is not a time to be reckless. This is a time to be smart, to be cautious, and to protect yourself. Let's look at the facts and understand the risks. History has a way of repeating itself, especially in the stock market. We've seen this kind of market concentration before. In the 1920s, a handful of companies dominated the market. It felt like easy money. People kept investing, pushing prices higher. Then came the crash. The Great Depression wiped out fortunes. It happened again in the late 1990s with the dot-com bubble. Tech stocks soared. Everyone wanted in. But many of these companies were built on hype, not profits. The bubble burst. Investors lost billions. More recently, during the COVID-19 pandemic, we saw market concentration rise again. Tech giants benefited from lockdowns. Their valuations skyrocketed. This mirrored the trends of earlier bubbles. These historical examples should serve as a warning. What goes up too fast can come crashing down even faster. We need to learn from the past. Why is market concentration a problem? Because it makes the market unstable. It creates a house of cards. Here's how. First, it distorts the market. When a few companies get too big, their performance skews the entire market's performance. It looks like the market is doing great, even if most companies are struggling. Second, it increases risk. If one of these giant companies falters, the whole market can tumble. A single bad news event can trigger a domino effect, leading to a major correction. Third, it encourages speculation. When investors see a few companies doing well, they pile in, hoping to get rich quick. This drives prices up even further, creating a bubble. We need a healthy market where many companies thrive, not just a select few. Section 4. Overvalued? The warning signs are flashing. So, are we in a bubble? Are stocks overvalued? There are some worrying signs. One measure is the stock market to GDP ratio, also called the Buffett indicator. It compares the total value of the stock market to the size of the economy. Historically, a high ratio suggests stocks are overvalued. Right now, the ratio is flashing red. Another indicator is the CAPE ratio. It looks at stock prices relative to their long-term earnings. A high CAPE ratio suggests stocks are expensive compared to their historical averages. Guess what? The CAPE ratio is also elevated. Beyond the numbers, we see signs of speculative behavior. Investors are pouring money into trendy sectors like they did during the dot-com boom. This fear of missing out can lead to irrational decisions. While no one has a crystal ball, these warning signs are impossible to ignore. Section 5. Navigating the market, a guide for investors. So, what can you do? How do you protect yourself in this uncertain market? First, diversify. Don't put all your eggs in one basket, especially the biggest baskets. Look beyond the top 10 stocks. Explore mid-cap and small-cap companies. Consider international stocks. Second, focus on fundamentals. Don't get caught up in hype. Look for companies with strong balance sheets, steady earnings, and good management teams. Invest in businesses you understand. Third, prepare for volatility. The market can swing up and down quickly, especially during times of uncertainty. Have a plan for what you'll do if the market drops. Don't panic sell. Fourth, use dollar-cost averaging. Invest consistently over time regardless of market ups and downs. This helps you buy more shares when prices are low and fewer when they're high. Remember, investing is a marathon, not a sprint. Stay focused on your long-term goals. Conclusion. Be vigilant, be disciplined. The market is sending mixed signals. It's easy to get caught up in the excitement, but remember, bulls make money, bears make money, pigs get slaughtered. Don't let greed cloud your judgment. Stay informed, stay disciplined, and never stop learning. Your financial future depends on it. Remember, knowledge is power, and it's never too late to take control of your money. Join Up Education today and learn how to make smart financial decisions for a brighter future.